To order. It's fitting that this hearing falls between tax filing day, which was moved to April 18 this year, in case you haven't filed your taxes, and Tax Freedom Day, which occurs on April 24th. As Mr. Hodge may explain, Tax Freedom Day represents the day taxpayers can stop working to pay off what they owe the government and start earning for themselves and their families. Unfortunately, Tax Freedom Day does not include freedom from complexity. Throughout the year, taxpayers will have to gather and store receipts and records to deal with next year's filing deadline. Some taxpayers will even make business or even personal life decisions based on some quirk in the tax code. I was looking for a tangible example at this hearing of just how complex our tax law is. And rather than stack up and tear down a whole forest of trees to print, that's why these boxes are stacked up in front of the dais. In 2014, a publication that includes the tax code, regulations, and court decisions that determine tax law totaled over 74,000 pages. If my staff had printed this out, we would need 15 boxes of paper that are represented here. Now, I've got good news and bad news to report with respect to 2015. The good news is that the latest version of the tax code has fewer pages. We wondered how that could happen, since I think, as we'll hear from our witnesses, we're adding to and not taking from, simplifying the tax code in any way. But it was due to not an increase in the number of tax laws. It was because an explosion of pages no longer could fit in the binders. So the publisher shrank the font size. For those of us whose eyesight is not as good as it used to be, we will be ever harder to pay attention to the fine print that exists in our tax code. And it's no wonder 90% of taxpayers pay a tax preparer or buy computer software to help them figure out their tax burden. Even before the new tax complications of the Affordable Care Act, the Internal Revenue Service estimated that taxpayers spent over 6 billion hours each year preparing and filing taxes. Estimates of the dollar cost to taxpayers range in the hundreds of billions of dollars. Complexity comes with many costs. Aside from the frustration and anxiety it causes taxpayers to spend time and energy that could be put to much more productive uses. It costs the Treasury, since taxpayers make innocent mistakes and are never exactly sure what they owe. And it breeds a sense of distrust in the system when taxpayers suspect others are getting a better deal because they figured out how to game the tax code. But is there a real economic cost? Would America as a whole be dramatically better off with a much simpler, much fairer, much more pro-growth tax code? I think I know the answer, but I look forward to hearing from our witnesses with their views on this subject. Today we'll hear from Dr. Art Laffer, known as the father of supply-side economics. We also have Scott Hodge of the Tax Foundation, which is famous for its tax research. We will also hear real-life stories from Joe Grossbauer, a small business owner who lives with tax complexity every day. And our final witness is Bernstein of the Center for Budget and Policy Priorities. My thanks to all of you for coming here today. We look forward to your testimony. I now recognize Ranking Member Maloney for her opening statement.
Thank you so much, Chairman Coates, for calling this a hearing, and to all of our panelists. We are here today to talk about simplifying the tax code. Most Americans think our tax system is too complex, and I believe we all agree. But simplifying the tax code will be a massive undertaking. It will be politically difficult. It will create winners and losers. That's because simplifying the code requires eliminating some of the tax credits, deductions, and exemptions that make it complicated. Those who benefit from these provisions will fight tooth and nail to protect them. That's why we should be very wary of anyone who offers a quick and seamless, painless fix. Some things are worth protecting, like the home mortgage interest deduction that enable Americans to achieve the American dream of owning a home. Others widely benefit society, like the charitable deduction that helps support museums, parks, and other important charities, and some credits incentivize behavior that broadly benefits the economy, like the research and development tax credit. Some credits are critical to giving working families a chance to succeed, like the earned income tax credit. However, many loopholes in our tax code are just giveaways to narrow special interests. These are often buried deep in the fine print, making the tax code more complicated and less fair. So yes, we should simplify our tax system. We should make it as easy as possible for individuals and small businesses to do their own taxes and pay them. We should enable companies to spend less money on tax accountants and more on building their businesses. And we should plug some of the thousands of loopholes that not only complicate the tax code, but allow some to take unfair advantage of it. But at the same time, we should make sure that our tax system raises enough revenue to provide Americans the services they expect from their government and that they need. And we should create one that makes the vast majority of Americans better off than they are today, or at least not worse. But I fear that many proposals that conservatives claim would simplify the tax code are not really about simplification. Rather, they're about radically restructuring who pays how much. One proposal in the House Republican budget is to reduce the number of brackets in order to lessen complexity. Some would go further. A plan backed by hearing witness author Laffer is to create one flat tax. This would reduce the total number of brackets to one. This means that a family that earns $50,000 would pay the same tax rate as a family earning $50 million. Many conservatives claim these simplification plans that translate into huge tax cuts for the wealthy won't increase deficits and won't affect the government services that many Americans believe are necessary. The theory is that tax cuts pay for themselves. In other words, cutting taxes can translate into such massive economic growth that it leads to higher government revenues. This means that tax cuts supposedly can take place without offsetting spending cuts. Americans supposedly won't lose any of the government services on which they depend. Social Security won't be touched, or Medicare, or education funding. Our national defense will remain strong. Our highways won't be allowed to fall into disrepair. We won't have to cut funding for dreaded diseases like the Zika virus. But this math simply does not add up. Tax cuts don't pay for themselves. Tax cuts don't necessarily lead to strong economic growth. But they do lead to lost revenue and higher deficits. This is the lesson of the past 35 years. Despite tax increases under President Bill Clinton, we had a booming economy and created more than 22 million private sector jobs and 4 straight years of budget surpluses. And then we had 2 tax cuts under former President George Bush, which contributed to massive budget deficits, with the tax cuts by themselves adding, according to some economists, $1.5 trillion to deficits over 10 years. So in summary, when we talk about making the tax code less complex, let's not be fooled into claims that we simply need to flatten the code. My time is up, I guess. This will make it more regressive, shifting more of the tax burden onto the middle class and the poor. And let's not continue to pretend that tax cuts pay for themselves. History has shown that they do not in recent history. And so let's get down to the business of simplifying the tax code and making it more fair. I truly look forward to this very impressive panel and hearing your testimony today. Thank you.
Ranking Member Maloney, thank you very much. I'd like to introduce our panel of witnesses. Dr. Arthur Laffer is an incredibly well-known figure in tax policy circles. He is currently the chairman of Laffer Associates in Nashville, Tennessee, and long before that he held various esteemed positions, including chief economist at the Office of Management and Budget and a member of President Reagan's Economic Advisory Board. Most economists and policymakers are familiar with the Laffer curve, which shows the trade-off between tax rates and revenues. As legend has it, Dr. Laffer pitched it by drawing it on a napkin at a dinner. Since then, he has been a prolific author on tax policy. Dr. Laffer, we welcome you. Mr. Scott Hodge is another well-known expert in tax policy and the president of the Tax Foundation. which calculates the tax freedom day that I mentioned in my opening statement. He is one of the many creative drivers behind both the Tax Foundation's dynamic scoring model and the State Business Tax Climate Index. Mr. Hodge has authored over 100 studies and conducted hundreds of interviews on tax policy and government spending. Mr. Hodge, we appreciate you joining us today. From Chesterton, Indiana, we have a fellow Hoosier, Mr. Joseph Grossbauer, the founder, president, and CEO of GGNet Technologies. His company provides IT management, data security, and data center services for a variety of clients. Previously, Mr. Grossbauer was the director of Mercy Hospital and Medical Center in Chicago and an adjunct faculty member at Columbia College. Mr. Grossbauer, it is a pleasure to have a Hoosier business owner with us today, and I thank you for taking time out of your schedule to come down to D.C. and testify. And finally, we have Dr. Jared Bernstein, Senior Fellow at the Center for Budget Policy and Priorities here in Washington, D.C. Before joining the Center for Budget Policy and Priorities, Dr. Bernstein served as the Chief Economist and Economic Advisor to Vice President Joe Biden and Executive Director of the White House Task Force on the Middle Class. Before joining the Obama administration, Dr. Bernstein was a Senior Economist and Director of the Living Standards Program at the Economic Policy Institute. Dr. Bernstein, we welcome you also. With that, I'd like to turn to Dr. Laffer as our first witness, followed by Mr. Hodge, Mr. Grossbauer, and then Dr. Bernstein. In accord with our procedures here, we'd like to get your conclusions and summaries in a roughly 5-minute time frame, so it gives us plenty of time. We have a number of our members here from both the House and the Senate that would like to ask you questions and hear from you. So, Dr. Laffer, you're on.
I guess it's sort of like putting the TV inside the microwave so you can watch 60 minutes and 30 seconds. Just teasing. It's really fun being with these other witnesses here today as well, especially Jared Bernstein, who's a dear, dear friend for many, 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 many years and an excellent economist and good friend, and being with all of you. I guess I haven't been before this committee for 35 years, and I think it's about time we started doing tax codes again. And I'd like to also have read into the record, if I might, a paper I did with John Childs, which is the economic burden caused by tax code complexity, which covers a lot of what you just talked about, Mr. Chairman.
Without objection, we'll put that in the record.
Thank you. But what I would like to do is, Mrs. Maloney, I'd like to go right at the comments you made, and very interesting, and I understand. What I'd like to do is remove this from being partisan, if I may. It's not Republican, it's not Democrat, it's not liberal, it's not conservative, it's not left-wing, it's not right-wing. This is economics. And in fact, as some of you may know, I was a huge fan and voted for and did campaigning for Bill Clinton when he ran for office as president. I voted for him twice. I also did Jerry Brown's flat tax. In fact, I did it verbatim when he ran in the primary in 1992. And what I'd like to do is
Don't go too far, because we invited you.
Oh. You know, I'm a Reagan guy all the way. So
All right,
yes.
that evens it out.
But it's not a partisan issue. It's all about economics and about the incentives here and the bill. What you say, tax complexity doesn't just mean lowering rates or making one rate. It means changing the base as well. I would like to give you an example of tax complexity and what it leads to. And this is someone you all are very familiar with, a man named Warren Buffett. A Frenchman from Omaha, Nebraska, you know, Warren Buffett. And I'd like to do, what he did was he wrote a letter to the New York Times in 2011, which described how he pays more taxes than his secretary does. In fact, he pays half as much in taxes as his secretary does. And in the letter, he said, now I pay a lot in taxes. I pay, and he said $6,900,000, whatever it is, I've got the exact numbers, but a little bit less than $7 million in taxes, which may seem like a lot of money to you. But in fact, relative to my income, it's not very much at all. In fact, he said, relative to my income, it's only 17.4% of my income. Now, being the math whiz I am, I went and took that tax bill, which was a little less than $7 million, divided it by 0.174, and I got his adjusted gross income, which was a little bit less, just a wee bit less than $40 million, which is a heck of a lot of money for one man to earn in 1 year in 2010. But then I went back to my Chicago training, University of Chicago training and asked myself, what really is income? Not the definition for the tax codes, but the definition you and I would like to have, Mrs. Maloney. I mean, very seriously. And your income should be how much you spend in a year, how much you give away in a year, and your increase in wealth. Now think about that income. It's what you spend in a year, what you give away in a year, and the increase in your wealth. That's your income from that year that you have to dispose of as you see fit. So I went to Warren Buffett, the records there, and I looked up in the Forbes magazine to find out what happened to his wealth. Now, he owns a company called Berkshire Hathaway, as you know. The stock is fully traded, so we know how much he owns and what happened to his wealth. And in the Fortune magazine that year, his increase in wealth was a little over $10 billion. It went from $37 billion at the beginning of 2010 to $47 billion at the end of the year. I then went to the Bill and Melinda Gates Foundation website. They announced that he had given $1.6 billion that year to the Bill and Melinda Gates Foundation. I didn't go to his two sons' websites, nor do I go to his daughters, but he gave them a lot of money as well. I didn't look at his checking account to see how much he spent. But when I looked at his total income for the year 2010, it wasn't $40 million. His income for 2010 was $11.6 billion, and his total tax bill was less than $7 million. He paid in taxes 0.06% of his income that year, all legal. What he did was his whole increase in his wealth is in unrealized capital gains. As you know, the tax rate on unrealized capital gains is 0, and on the increase is also 0. The gifts to the Bill and Melinda Gates Foundation and the other foundations also pay no tax whatsoever there. If you look at, he owns Berkshire Hathaway, so he never has to buy and sell a company's stock. It's all below the shelter there of the company, so all the realized capital gains don't come to him in taxes, just goes to the company. You know, this is all because of complexity. And all of it, and he's not the only example. If you have a low rate, broad-based flat tax that defines comprehensive income, the way Jerry Brown proposed it in 1992, you would catch all of this. This is what we really mean by a simplified code. Now, the code I wrote for Jerry Brown was not a tax rate reduction. It was much more like the '86 Tax Act, which had for every rate reduction, you had a broadening of the base to make it static, revenue neutral. So all of this revenue feedback stuff is not true for complexity. Now, the 1986 Tax Act, which was I was very involved in, I'd done this paper of my own as well as worked with Jack Kemp as well as Bill Bradley. What we did there was we made it down to 2 brackets, 15% and 28%. We got rid of deductions, exemptions, exclusions. We dropped the corporate rate from 46 to 34%, and it was static revenue neutral. If you look at that bill at that time, we passed in the Senate, and I'll just use the Senate vote. The Senate voted 97-3 to pass that bill. Now, can you imagine that bill being done today where we dropped the corporate rate from 46 to 34%, then the lowest in the OECD, and dropped the highest rate from 50% to 28%, and yet we got 97 votes in there. It led to enormous prosperity. My next-door neighbor and dear friend, a guy named Al Gore, who I did the blurb on his latest book, The Future, said it led to 15 years worth of prosperity, and it was the best economic vote he's ever done, period. That's what we're talking, bipartisan, pro-growth, lowering the rates, broadening the base, and not making revenue shortfalls, not worrying about spending, but trying to create economic growth by really, really significantly reducing complexity. Thank you.
Thank you very much, Mr. Chairman, and Ranking Member Maloney and all the members of the committee. I appreciate the opportunity to talk about tax complexity. My goodness, it's the #1 issue facing Americans today. In addition to robbing us of 6 billion hours of our lives complying with the tax system, tax complexity punishes success and hard work, which robs the economy of its ability to create jobs and prosperity and better living standards. And over the past few months, the Tax Foundation economists have actually been measuring the cost of complex provisions in the tax code using our taxes and growth macroeconomic tax model. And in May, we will publish these case studies in a new book titled Options for Reforming America's Tax Code. And I hope that these case studies provide you with some do's and don'ts as you go about thinking about fundamental tax reform. And what we find is that much of the complexity of our individual tax code in particular results from our attempts to make the tax system more progressive, either overtly through multiple brackets and rates or covertly through backdoor clawbacks. And as we all know, and as Dr. Laffer has talked about, high marginal tax rates really matter. They work to diminish incentives. That ultimately undermines economic growth. And economists have referred to these high tax rates as success taxes, properly defined, I think. So, for example, we can make our current income tax system a lot simpler by reducing the number of tax brackets from 7 to, say, 3. It would be simpler, more pro-growth, and still progressive if we had rates of, say, 10, 25, and 35%. And our model estimates that this would boost the long-term level of GDP by 1.4%, lift after-tax incomes by 3%, and create more than 1 million jobs. But we also find that our policies aimed at helping the working poor also have unintended consequences. The complex structure of the Earned Income Tax Credit has the ironic effect of encouraging more growth as the subsidy phases in, but discouraging work effort as the subsidy phases out, because it penalizes workers for every new dollar that they earn above the poverty level. However, we can reduce those tax penalties with a slower phase-out rate for the ITC, and our model finds that this would raise workers' after-tax incomes by 1% and create as many as 164,000 new jobs. You know, I think we all want to simplify the number of loopholes and itemized deductions in the code, but we should use the savings from that simplification for lower tax rates. We found that if you were to eliminate most itemized deductions, except for the charitable deduction and home mortgage interest deduction, and reduce tax rates across the board by 10%, it would increase GDP by 0.6% and create more than 577,000 jobs. On the business side, everyone on this committee knows that the U.S. has the highest corporate tax rate in the industrialized world, along with an obsolete worldwide tax system. Cutting the corporate tax rate and moving to a territorial system would not only simplify the tax code, but make the U.S. a more competitive place to do business in and do business from. But just as important, we should replace our immensely complicated depreciation and cost recovery system with a much simpler system of full expensing for capital investment. Dollar for dollar, full expensing is one of the most pro-growth tax simplification measures this Congress could enact immediately. And by our estimates, full expensing would increase the long-run level of GDP by over 5%, boost our capital stock by 16%, increase wages by more than 4%, and create more than 1 million new jobs. Over the past year, the Tax Foundation has been very fortunate. We've gained a lot of special insights into what kinds of tax policies lead to greater investment, wages, jobs, and economic growth, and what kind of policies actually retard that. And we've scored the tax plans for every presidential candidate, as well as numerous plans developed by members of the House and Senate. In fact, we scored the plans of 2 members of this committee, Senator Rubio Lee tax plan and Senator Cruz's tax reform plan as well. And during this experience, we've modeled every conceivable tax reform plan one can think of, including the flat tax, fair tax, Bradford X tax, value-added tax, and numerous plans that blend all of those different things together. And to one degree or another, the plans that produce the most economic growth tend to incorporate many of the things that I've just outlined. They simplify the tax code, they reduce marginal tax rates, they reduce taxes on capital, they reduce or eliminate the double taxation of savings and investment, and they move toward a neutral or consumption tax base. Well, to wrap up, I hope that members of this committee, as well as all of your colleagues, take some of these lessons to heart and start us down the road to fundamental tax reform sooner rather than later. Thank you very much. I appreciate the time and answer any questions you may have.
You nailed the 5-minute time limit. We give stars for that, so we thank you. Right. Mr. Grossbauer, you're joining some rarefied company here. Warren Buffett, Bill Gates, Jerry Brown, Al Gore, Bill Bradley, Jack Kemp. What does the small business owner want to tell us about our tax code?
Thank you, Senator Coates. And listening to the billions of dollars being spoken here, and they say a billion here, a billion there, and the hundreds of thousands of jobs being created or could be created. I want to preface my presentation by saying that $1,000 investment, $1,000 outlay is a significant outlay for me. It is not, it's something that I think about very seriously. I think about, when I capitalize a piece of equipment and it cost me $5,000, that's a big deal to my small company. Expanding by 1 or 2 employees is a really big deal for my company. I just have to say it's really a great honor to be here, and I really appreciate the opportunity to share my story. I want to thank you all for allowing me to be here. And I also have to warn you, I'm quite nervous. This is something that's clearly out of my comfort zone. So if I flub a word here or there, please excuse me. And now let me get on to my points. I want to say good morning, Chairman Coates, Ranking Member Maloney, and members of the Joint Economic Committee. Thank you for the opportunity to testify today. I'm pleased to be here on behalf of the National Federation of Independent Business, NFIB, as the committee discusses the issue of tax complexity and its negative impact on our nation's economy, and especially small businesses. NFIB is the nation's leading small business advocacy organization. The typical NFIB member employs 8 to 10 people. With an annual gross receipts of about $500,000. So when you talk billions, we're not talking billions here, but we are talking about people who are really in the trenches every day, growing their business. All the NFIB members are independently owned, which is to say none are publicly traded corporations. While there's no one definition of small business, the problems NFIB members confront relative to the tax code are representative of the vast majority of small businesses. And I'm glad the hearing was this week and not last week, because I really literally could not have attended last week. And I didn't know that tax day was due Monday because I was so busy worrying about taxes. I got panicky on Friday the 15th thinking I needed to file my taxes, and luckily I had an extension over the weekend. A few consistent concerns are raised regardless of the trade or industry in which small businesses are engaged. And 5 of the top 10 small business concerns are tax related. And these tax problems fall into 3 categories: cost, complexity, and frequent changes. And I would submit frequent changes are just additions to tax complexity. When I started my business 10 years ago, I could prepare my taxes myself, but now I have and you've got to remember, I have a staff of 6 people. I have a staff bookkeeper, I use an accounting firm, and for the really tricky questions, I have a tax attorney. This is really crazy, I'm serious. This is really crazy to have a small business having to, call up their accountant or their tax attorney just to check on something. I'll give you a very specific example. I serve as president and CEO of GGNet Technologies, which is a technology company that provides IT and data center services along with cybersecurity, breach analysis, and mitigation. We are an S corporation. Since our founding in 2006, our accounting costs have risen more than 400%. Some of that can be attributed to company growth, but much of it is in the rise of accounting costs due to the complexity of the tax code. It seems like the harder I work, the more I grow. It's not necessarily the more taxes I pay, it's really the more complex the tax code has made my life. I deal with things like, deductions, and how do we deal with those deductions? Do I deduct something? I deal with pass-throughs, active and passive incomes, classification of items. Tax compliance is really now way beyond my capability, and I can deal with pretty complex situations in my business. I'm no longer small enough to prepare my own taxes, but I am not large enough to have an entire accounting staff. My bookkeeper spends roughly 40% of her time working on tax-related functions, classifying various items, and filing federal, state, and local taxes. Like the doctor in surgery discovering a much more complex situation and having to call in other specialists, it takes much more time and a much higher cost. Between February and April, my bookkeeper and I are frozen. We don't focus on anything else primarily except taxes. Business reports and planning are put on hold or delayed because we are so focused on taxes. We are unable to produce timely reports on cash flow or profit loss. This is not the way to run a business. I can't even during this time accurately project my staffing needs. I do it, but it's not as good as it normally would be. If the tax code were less burdensome, I'd be able to focus more time and resources on my customers, product development, and services rather than taxes. And even a small company like mine, you know, looks for innovation. How can we be different? And I don't have the time to do that. Every day, I have to think about taxes. How do I classify an item? Do I classify it under operations, capital, or minor equipment? And if capital, I have to consider, you know, the depreciation formula. I mean, really, you know? I always seem to be calling my accountant. Another decision, we talk about job opportunities. I would really like to add more staff, but I just keep using contract workers and I follow the IRS code rather than hire a new employee, knowing that the new employee would bring additional costs and tax overhead. Payroll complexity forces me to use software. Software doesn't always classify well, and we end up with support calls to companies and my accountant. And now we talk about economic development, and we talk about economic development in Northwest Indiana. I discovered an underutilized fiber optic network in my community. I teamed up with 3 partners to set up an LLC to acquire this asset. This would bring, and we all talk about gigabit service to communities, this would bring gigabit service to homes and businesses. I would need to build a network operations center, small. I would have to hire an engineering staff, well-paid engineers, to make this opportunity work. As we developed our business plan in pro forma, we recognized the need for correct interpretation of the tax code in order to determine if this was a profitable or unprofitable venture. We did the market analysis. We projected income. Everything looked good. We calculated startup costs. Good. Everything looked really good. But as part of the due diligence, we needed to project our tax liability. The fiber in the ground became the problem. One accountant said it was a capital asset, and we'd have to depreciate it like that. This just didn't work, the numbers didn't work. Bottom line is the numbers didn't work. So on the recommendation of one of our partners, we went to his accountant, reviewed it, looked at it, and said the same thing. Fiber in the ground is a capital expenditure. You have to depreciate it as capital. So I finally went to an accountant friend of mine, just handed this off to him and said, you know, what can I do? And he said, no, you're stuck. So at this point, acquiring the fiber became a risky venture, and the partners were getting nervous. Out of the blue, or call it dumb luck, I read an article in one of my news feeds telling me that the IRS has reclassified fiber as real estate. So I went back to my accountant and showed him this, and he said, oh, no, it was capital. It's capital. I know the law. It's capital. Okay. So now I said, okay, let me go to my tax attorney, you know, always deals with these kind of situations. And he read the article, and he said, well, it sure still seems like capital. So I pushed him, and he called an associate of his. I don't know where he ended up calling, but he checked further, and he said, yes, this can now be classified as real estate. That changed the entire picture. So I've yet to receive all the bills for this, but I think that the investment will be worth it. But I want to say no small business should have to go through this trying to build a company and create jobs. The tax laws, and I can't emphasize this enough, the tax laws should not be a barrier to growth. And they are a barrier to my small business. I'm a middle-class person. I'm not a Warren Buffett, you know. I really work very hard, and all of my staff are middle-class people. And the current tax laws are truly a barrier. When I look at that wall over there, they are a barrier to my growth. In conclusion, small businesses are the engine of economic growth. This is not just a slogan of small businesses. I'll give you some statistics. Created 2/3 of the net new jobs over the past decade.
Mr. Grossbauer, I've given you extra time here.
Okay, I'm sorry.
But I did so because you're giving us a real live example of the average guy gal out there trying to run a business, everyday life, and make a
Sure.
little bit of profit. And the amount of, you've given us a real live example of this, and we talk in mega terms up here in terms of theory and so forth, and you've brought it down to us. And
I appreciate
made
the
an impression
opportunity.
on
Yes,
me. So I'm
thank you.
going to just cut you off at that point.
That's fine.
But
No
thank
problem.
you.
Thank you.
Thank you.
Well, thanks very much for the invitation. I, too, appreciate your testimony, Mr. Grossbauer, in that spirit. And I want to try to emulate my old friend Art here and begin with a kind of broader view of the question at hand. Today's hearing is about tax complexity, but we can't really address that issue unless we ask a broader question, which is, what is the goal of the federal tax system? This goal should be to raise the revenue necessary to fund the government services and public goods that Americans want and need, but to do so in a way that's fair, equitable, pro-growth, and avoids unnecessary complexity. So my testimony has three main findings. Fairness, simplicity, and revenue raising are often complementary. By closing regressive loopholes in the tax code, we reduce incentives to game the system, close wasteful tax breaks that exacerbate inequality without promoting growth, and raise more revenues. Based on demographics, inflation, debt service, and rising health costs, a substantial fiscal policy, a sustainable fiscal policy will likely require more, not less, revenue going forward. And finally, I find no evidence in support of the claim that supply-side tax cuts come anywhere close to paying for themselves or even particularly pro-growth. Now, the complexity in the tax code has nothing to do with the number of tax brackets and rates. If taxable income were easy to define, it wouldn't matter how many rates existed in the code. All taxpayers would have to do is to look up their liabilities in a table or an online calculator. Instead, and the other witnesses have all said the same thing, what makes our system so complex are the exemptions, deductions, privileges for certain types of incomes and activities, and other loopholes that often allow wealthy and businesses flush with tax lawyers to pay less than their fair share. This problem is readily seen on the business side of the tax code, which is so fraught with complex loopholes that the effective corporate tax rate is 10 to 15 percentage points below our uniquely high top statutory rate of 35%. One notable distortion here is the fact that debt financing for business investments is heavily subsidized by the tax code. Another is the infinite deferral of foreign earnings. That's one reason why the foreign income of U.S. multinationals is taxed at a rate 10 percentage points lower than their domestic income. Now think about this for a second. Our tax system actually incentivizes production in Guangdong Province versus Providence, Rhode Island. What should we do? Cutting taxes is no free lunch. In my testimony, I have a bunch of scatter plots. I have a few here up on the slide projector there, showing that the top marginal rates faced by wealthy Americans have historically been uncorrelated with GDP growth, employment growth, investment growth, productivity, middle-class income, as far back as we have the data. As Ranking Member Maloney said, this should come as no surprise to those who've lived through the Clinton years, where higher top rates coincided with economic outcomes much better than those during the George W. Bush years when rates were lower. The state of Kansas' recent experience have proved the prediction of these supply-side tax cuts spectacularly wrong, as cuts recommended by advocates of the trickle-down theory have both caused serious underfunding of the state's education system and have coincided with weak job and GDP growth. Fortunately, there are changes to the tax code that can simultaneously simplify it, raise revenues, improve fairness, and enhance economic efficiency. My testimony provides examples of such changes. An easy and obvious starting point is closing the so-called carried interest loophole, which allows hedge fund managers to face favorable asset-based rates on their earnings. Those who claim to want to undertake major tax reform yet are unwilling to close this loophole, one with virtually no defenders, should be considered akin to those who say they're ready to run a marathon but get winded walking up the stairs. Broadening the estate tax base and ending step-up basis would reduce the preferential treatment on inheritances of millionaires. A minimum tax on foreign earnings would help fix the deferral problem, as would efforts to crack down on the increasingly evident problem of illegal tax evasion. One last point. U.S. foreign profits booked in tax havens have grown sharply in recent years. In 2010, foreign subsidiaries of U.S. firms reported profits in the Cayman Islands that were more than 20 times that country's entire economic output. 20x their GDP. This simple fact alone provides overwhelming evidence of base eroding profit shifting from where income is earned to where it will be taxed. I look forward to further discussion of these and other ways to dial back the complexity in the code while dialing up its fairness.
Dr. Bernstein, thank you. Let me start with some questions here, and I'm going to try to only do 5 minutes, so I set the example for my colleagues here. But you know, I cannot resist asking Dr. Laffer to respond to what you said, Dr. Bernstein, particularly in terms of pro-growth and supply-side economics. And my recollection is that after the 1986 Act, we were growing at a rate I've never seen in my lifetime. But I'd like to, and then I want to give you a chance to rebut that. So within 5 minutes, Art, you have about 2.5 minutes to give us your thoughts on this subject. And then, Dr. Bernstein, if you want to go back and forth, I think it'd be entertaining for us.
Just like the old days, Art.
Like the old days, and informative.
Back away.
Yeah, I was wondering,
We'll, when it comes to the next question, you know, hopefully somebody will ask you, Mr. Hodge, what your opinion is. I'm just trying to stay within my 5 minutes. Go ahead, Art.
If you take the 9 states with no income tax and compare them with the 9 states that have the highest tax rates. Oh, sorry. Oh, there, I pressed it again, wrong. Sorry. If you take the 9 states that have no earned income tax in the U.S., if you take the 9 states with the highest tax rates, if you look at their growth rates over the last 50 years, every single year, the 9 states without income taxes, earned income taxes, have grown much faster in every single metrics than have the 9 states with the highest income tax rates. Clear-cut example of growth rates, taxes, same country, same time, same place, same station. If you look at the 11 states that have introduced an income tax in the last 60-plus years, starting with West Virginia and ending with Kentucky in 1991, each and every one of those states in every single metric, each and every one, in every metric, population, employment, labor force, and yes, even tax revenues, declined relative to the rest of the nation without exception. If you look at the growth rates of Germany and Japan in the post-war period, all of these data, but most of all in the academic literature. If you go to the academic literature of the top journals, you can find all over the place measures of taxes affecting growth. In fact, Christina Romer, her famous article shows the effects of tax rate reductions on economic growth, and she, I think, was Obama's chief economist there for a while. So the literature is just full of those examples when done carefully and academically that really show that tax rates do matter. You know, if you tax people who work and you pay people who don't work, do I need to say the next sentence to you? Don't be surprised if you find a lot of people not working. That's all we're talking about. We tax speeders to get them to stop speeding. We tax smokers to get them to stop smoking. Why on earth do we tax people who earn income? Why do we tax people who employ other people? Why do we tax businesses that make wonderful products at very low cost? To get them to stop earning income? To get them to stop employing other people? To get them to stop making wonderful products at low cost? No, we don't. We do it to get the revenues. But don't for a moment believe that they don't have negative consequences. You know, that is the ultimate false hope, is you've got to have a clear eye to be able to also have a warm heart. You've got to be able to look at the consequences and make a tax plan that does have trade-offs. Taxes do affect growth, they do affect incomes, they do affect jobs, but we need the money. And how do you get those revenues in the least costly fashion and provide those resources to government for the most beneficial uses possible?
Dr. Bernstein?
Thank you very much. I
Your rebuttal.
appreciate your giving me the opportunity to go back and forth. In my testimony, I list 5 scatter plots that I'd like to share a couple of with you right now. This idea cannot be asserted, it cannot be found in the literature the way my friend Art does, because I can find just as many studies that go the other way. It must be empirically tested. And what we did here is we took every single year we have on record of tax changes and a whole set of variables. There's 5 of these slides in my testimony. GDP, productivity, labor supply, capital supply, investment, median family income. And we simply asked, to what extent does the growth in these economic variables correlate with the top rate in the income tax code? If the supply side claims were correct, we would see an inverse correlation. We would see that growth was consistently more positive, whether it's investment, income, GDP, productivity, when rates were low, and vice versa when they were high. Instead, in every single plot we made, I mean, I really bent over backwards to try to get to the bottom of this, the correlation was about zero. In fact, if anything, it was slightly positive and significantly positive when we looked at median family income, meaning that over the course of history, family income grew more quickly when rates were higher than when they were lower. Now, I'm not saying, and I'm not at all claiming, and I want to be clear about this, that higher rates, in fact, drive growth and investment up. I'm saying that the correlations are not there. And if the correlations are not there, it would be an extremely, I think, reckless mistake to try these supply-side solutions at home. And by home, and I'll finish with this because I know we're crunched for time, by home I mean Kansas, for example. In Kansas, the governor and the legislature aggressively cut taxes, urged by policy officials touting the benefits of supply-side tax cuts. They've blown a hole in their budget, about a $400 million hole in the state budget. Serious underfunding to the state's education system, of great concern to constituents throughout the state. And jobs now in Kansas have been growing half as fast, at a rate that's half as fast as jobs growing in the 4 surrounding states. So this is an empirical question. It's not a theoretical question, and the empirics, I think, tell you the answer that I stress in my testimony.
Well, I'd love to get in a debate here, and but two things have happened. One, I've been just handed a note that the House is expecting to begin votes at 3:30 on a series of those votes, so our House members will have to leave. I want to quickly turn it over here to our ranking House member, Mrs. Maloney, for her questions, and knowing you have to hustle out of here. So you are on.
Dr. Laffer, you were quoted in the Washington Post yesterday saying that the tax plans proposed by Republican presidential candidates Trump and Cruz could lead to, quote, massive revenue increases, end quote, to the federal treasury. Is that correct? Yes or no?
Yes, that's correct.
Okay. But Mr. Hodge, you've written something very different. In an op-ed last month, you wrote that the Republican candidates' tax plans would, quote, cut federal tax revenues substantially, end quote. And this was your article on which GOP candidate's tax plan is.
That's correct.
Yeah. And Mr. Hodge, would the Trump and Cruz tax plans increase revenues or reduce revenues?
Both of the plans are tax cut plans, and they're intended to be tax cut plans. We modeled all the presidential candidates' plans. We found that there's an interesting trade-off in sort of 3 trade-offs.
But first of all, just can you answer for me, because I want
sure.
to go back to the tax brackets, and I don't have much time.
Sure.
But you said that they would, quote, cut federal tax revenues substantially.
Right. The Trump plan is in conventional terms is a $12 trillion tax cut. After we factored in the economic growth, it's a $10 trillion tax cut. The Cruz plan, we find, is on a conventional basis a little over $3 trillion. But once you factor in the substantial economic growth that it generates, about 14% increase in GDP, that cost comes down to about $800 billion over 10 years. But
you wrote that they cut federal tax revenues substantially.
That's what I'm saying.
Yeah.
Yeah.
Okay, I want to go back. We have two separate proposals before Congress right now. There is one, and I'd like to ask Jared Bernstein. One would reduce the number of tax brackets to 3. This is one put forward by the Republicans, and some have supported cutting, following Dr. Laffer's suggestion of a flat tax, one that is one rate for everyone. So I'd like to ask Dr. Bernstein, is this an effective way to reduce tax complexity? What would be the impact of fewer tax brackets on the share of the tax burden shouldered by the middle class? And how would the wealthiest 1% do under these two proposals?
Well, as I tried to stress in my testimony, the complications of the tax code, all those boxes over there, are simply not driven by the number of rates. This, by the way, is a finding I think I've seen in all the testimonies you've heard today. The complications are driven by all the different definitions of income, the exemptions, the incentives to defer income overseas, to finance investments with debt versus equity, to defer foreign earnings, and so on, all the things we've been talking about today and the things that Mr. Grossbauer is busy with February through April. That wouldn't change one whit if he or other filers had one rate as opposed to 3 or as opposed to 12. I actually asked a tax accountant about this, and I quote her in my testimony about this question of rates versus the other aspects of complexity, and she called it, quote, gut-busting laughable that somehow reducing the number of rates would make a difference if you left all these other complexities in place. The other problem you face, as you intimated in your question, is that typically if we're trying to be revenue neutral and we reduce taxes at the top, which is characteristic of the kinds of plans you've been talking about, and certainly characteristic of those put forth by Republican candidates mentioned earlier, if those are going to be revenue neutral, you have to make the revenue up somewhere else. And so typically they increase the tax burden on the middle class.
And what does history show us about the impact of tax cuts on revenue?
If you, this is actually a fairly simple relationship that can be, I think, distractingly made more complicated by some of the mythology around supply-side tax cuts. I mean, historically, if you cut tax rates significantly, you will lose revenue on net. Now, I want to be very clear. I am not contradicting my fellow witnesses in terms of the following point. There will be, potentially, under certain conditions, more capital investment, more labor supply, under some tax cuts. That's not saying, but on net, the question is, how much will you get back through these growth effects versus how much will you lose? And I think history is pretty clear on this point, that the growth effects of the kinds of tax cuts that are being bandied about here today don't come anywhere close to offsetting their revenue cost.
Okay. My time has expired. Thank you. Thank you.
Thank you. Our Vice Chairman, Mr. Teaberry.
Thank you all for being here. Mr. Hodge, something in your testimony really jumped out at me. You mentioned that the multiple depreciation schedules that we have in place create often a complex and arbitrary process. As you know, and we've talked about before, I introduced a bill to make 50% bonus depreciation permanent. I was pleased with what was included in the PATH Act that was passed last year and signed by the President to extend it for 5 years, but I think we should go further, and I know you do as well. You mentioned in your written testimony that one way to both simplify the tax code and increase economic growth would be through full expensing. Mm-hmm. You modeled my 50% permanent depreciation bill, and I think you've also modeled Representative Nunes's ABC permanent full expensing bill. And I know in my bill's case, you stated that it would increase GDP by over 1% a year and create over 200,000 jobs. And you mentioned in your verbal testimony what full expensing would do. But you also say, and I quote from your written testimony, dollar for dollar, full expensing is one of the most pro-growth tax changes that Congress could enact. Mm-hmm. And last week, I asked that same question to Tom Bartold, who, as you know, is the chief of staff at JCT. And I gave him a story about a manufacturer in my state that said they modeled whether to build a plant overseas or in the United States, and because of the temporary law of bonus depreciation, they decided to build the plant in Ohio, thereby providing more employment and paying more taxes in our state. So to me, expensing and full expensing in particular seemed like a no-brainer. When I asked Mr. Bartold about his thoughts and gave that example about expensing and bonus, he explained that, and I'm going to quote, while expensing reduces the cost of capital and increases investment, he also said there are trade-offs that occur at the same time, that government receipts would decrease, creating a larger government deficit, driving up interest cost. which could in turn ultimately increase the cost of capital. I know your modeling has maybe a different approach to that those trade-offs might not occur, but more importantly, even if they do, that we would see GDP growth at 5%, which we would obviously love to see and haven't seen for a long, long time. Can you tell us why you believe that even with those trade-offs, that growth would be around 5% in your modeling?
Well, I think that in this case, the joint taxes model is incorrect in reading into that deficits cause some increase in interest rates. I think the last 7 years has sort of proved that wrong. And especially with the numbers that we're talking about, with the global capital markets, a little bit of a deficit to pay for full expensing would not drive interest rates at all. In our model, we hold Federal Reserve policy constant, so we don't measure that at all. We just figure that the Fed would be accommodative of this. And so what we're looking at is the pure effects of moving to full expensing, which, as Mr. Bartold mentioned, dramatically lowers the cost of capital. That drives investment in new plant and equipment. Ultimately, that makes their workers far more productive. More productive people earn more, and in turn, that leads to a growing, healthy economy. And it leads to better living standards, and that's ultimately what tax policy should be doing. And I think that full expensing really ought to be first and foremost on the top of our agenda here, along with lowering rates, obviously. But expensing would be a powerful tool to gaining U.S. competitiveness, to bringing jobs back to the United States, especially high-paying manufacturing jobs.
Thank you. I've got a minute left. I'm going to yield back because we have a vote coming up, Mr. Chairman.
Thank you. Let me get my list here. It's unfortunate that votes have made a play here, but it does open up the possibility and the probability and the ability for Senator Klobuchar to go next.
Okay. Well, as I said, I could defer to one more House member if you'd like, and then go after that, so maybe.
You
someone
offered
can
to
get
do
in.
that.
Okay.
And thank you for doing that.
Okay.
Your colleague, Congressman Paulson.
All right, well, thank you. I think my
Same-
colleague
same state as-
from Minnesota. Minnesotans are Minnesota nice, so appreciate that. And Mr. Chairman, thanks for holding this hearing, and I think the focus has been very apt, just in terms of the impact of a very complex tax code on our economy. And it doesn't matter if you're an individual, small business, a large employer. This is probably one of the top concerns I hear about from many folks actually in Minnesota. Tax code's too complex, too costly, takes too much time to comply with. And I think the highlights are the lowlights. I think, as the chairman mentioned, you think of 9 out of 10 Americans having to have someone being paid to do their taxes for them or purchase the financial software, of course, and to do their tax. I remember one company, a large employer, you shared some great testimony, Mr. Grossbauer, but there was a large employer who spoke at the Ways and Means Committee not too long ago, and they talked about having a 17,000-page tax return. And so think of the army of accountants that have to go through that process and the ingenuity and the know-how that is not employed of helping the company produce more growth as opposed to just doing compliance needs. So I guess my question is this, and Dr. Laffer, you kind of already outdated yourself a little bit with the Reagan tax reform initiatives back in 1986, but if you could give some additional advice, you did some comparisons before with states and international, but if you could give simple, straightforward advice about what we should focus on the, we talked about growth, what would you advise as we're going through this 27-year opportunity, once in a generation opportunity again, to get it right, to do it right, and we will do this right, hopefully, right after the next presidential election, we'll be ready to go.
Yeah, that's the reason. Oh, excuse me. That's the reason I'm here today instead of I took a hiatus for 35 years because I think the opportunity is right now. And I think if we did the first thing here, what's been talked about here, expensing, corporate tax reduction to really kickstart the system, I think that'd be a wonderful one, not unlike Reagan's 1981 tax bill. But that should be considered a first step. You can do some simplification of personal income taxes as well, but the long-run position should be to make the tax codes do the least damage possible to collect the requisite revenues to run government. And if you look at that, what you want to do is have the lowest possible tax rate to provide people with the least incentives to evade, avoid, or otherwise not report taxable income. That's why I use the Warren Buffett example there. The lowest possible rate to do that, and the broadest possible tax base. So you provide people with the least places to which they can place their income and avoid paying taxes. So you really want to do the least damage amount. All taxes are bad. Some are worse than others. The reason we have taxes is to collect the revenues to run government. Then you want to spend your money in the best way possible. Both of those are really, really important. I mean, Mrs. Maloney, the issue there is tax simplification includes rates and base. And you can make it static revenue neutral like we did in the '86 Tax Act, and there's no reason why you can't do it. That's what I did with Jerry Brown's flat tax as well in '92. There was no net revenue loss static. And what you'll do is just generate pure economic growth. But the first ones I would kickstart with some of the biggest ones we dropped was a Democrat, by the way, amendment that we cut the unearned income tax rate from 70% to 50%. With Reagan, that was, I believe it was, I forget who was it, his amendment to the bill that Reagan agreed to do. It also cut the capital gains tax. That's what we have to do to kickstart. Once this economy starts going, then you can afford to really go into a much broader tax reform, just like we did in the '80s.
Mr. Grossbauer, if I could just real quick, we have 1 minute.
Sure.
But essentially, you talked about fiber optics getting categorized as real estate, but is there another example you have on the complexity of what you think the focus should be on, or what small businesses, that are the entrepreneurs, the engine of the economy, would want to have us focus on first and foremost?
Well, you know, listening to full expensing, one of the most difficult, am I on? Okay. One of the most difficult things is depreciation, and how do we depreciate capital items. I have data center space in Chicago. I have a lot of servers in Chicago. It's all capitalized. It's all capital equipment. And the depreciation laws are really, really, you know, hit my company very hard. And I can only imagine, you know, how it affects, you know, ArcelorMittal and U.S. Steel. But it does impact my company. So that's something that would make a clear impact on my company. You know, as we think about, you know, growth, this becomes a barrier. Thank you, Mr. Chairman. Yeah, thank you.
Thank you. Now, Senator Klobuchar.
Thank you very much, Mr. Chairman. I am a big fan on moving forward on tax reform and doing something about the trillions of dollars overseas. We certainly know this in Minnesota with the Medtronic situation, although that has worked out for us in terms of adding jobs in our state. But overall, that's just not how we should run our business situation. And so we not only need some rules, mostly I'm interested in corporate tax reform and trying to bring that money from overseas and creating incentives. But I was kind of stuck, Dr. Laffer, I do have one. You'll probably call it an aberration, but CNBC did their rankings of the best states to do business in, and maybe Dr. Bernstein knows this, but the #1 state to do business in was Minnesota. And we actually have a 3.8% unemployment rate, yet our taxes, we were just checking this, are somewhere in the middle. But at the top earners, Governor Dayton made some changes because we had a $6 billion budget gap and put them at 9.85%. So they're one of the higher tax rates for top earners. And CNBC said they've never had a state quite like ours. It's a bit more pro-union. It's a bit more higher wages, and it's also clearly is not in a low tax. I think Texas was second. But what they noted was more and more as with the economy stable, companies are looking at places with good infrastructure, high quality of life, well-educated employees. And I just thought maybe we might want to comment on that, Dr. Bernstein.
Yeah.
I have another question of you, Dr. Laffer, but I thought you might want to look at this strange aberration.
So if you look at
your
the
theory.
Kansas story, the slide
Yeah.
over there shows that for all their tax cuts, not only did they blow a revenue hole in their budget, but their job growth is half as fast as those of surrounding states. Well, if you break down those surrounding states, the states that are doing the best tend to be the ones whose taxes are actually higher, the ones who've experimented with supply side, Missouri to some extent, Oklahoma. They're finding economic results that are relatively worse than the others. And I do think, again, I'm not trying to say that raise your taxes and watch growth bust out everywhere, because what really matters is what you do with it. And I strongly disagree with Art's "I hate taxes" or "no taxes are good."
indeed.
It's all a matter of what you do with them. When you say taxes are all bad, you're also saying Social Security and Medicare are bad, because what
No,
supports
no,
Social
okay,
Security?
okay. No, I get it.
So my point is that if
Yeah.
you're going to use your tax revenue to create a business-friendly environment through infrastructure, through an educated workforce, you're going to draw business in. That's certainly been the Minnesota case. I mean, you know that better than I, but
Well,
that's
we
my
have
impression.
17 Fortune 500 companies. I think we're second per capita for Fortune 500. We may be something of a unique situation, making everything from the pacemaker to the Post-it note. But I do think that's an issue. Now, where we are having some major challenges, and Dr. Laffer, you're an expert on this, is the steel industry. Iron ore, we've lost 2,000 workers, where my grandpa was an iron ore miner. The plants are idle because of steel dumping, because of overproduction, because of Chinese currency manipulation. And I mean, the White House actually working on this quite a bit, but we're getting, Dennis McDonough went up north. We're really concerned about the security if we don't have a steel industry, and we're also worried about how we get ourselves out of this. So if you could, my remaining a minute and a half here, if you could comment on that and what you think we could do there.
Well, I was born in Youngstown, raised in Cleveland. We're a steel family all the way back. The problem with steel, as I see it, is location. And location is because of tax in part. Obviously, a lot of other factors come in. Minnesota's a lovely, wonderful state, by the way. It really is. And if you look at my rich states, poor states, which I do every year, I've had for the last 10 years with ALEC, you can see the rankings.
Okay, all right, but let's get to the
Let's get,
minute.
what you have now is U.S. companies are taxed at U.S. rates no matter where they make their profits, et cetera. If you have two locations, A and B, if you raise taxes in B and you lower them in A, producers and manufacturers and people are going to move from B to A. What we've done is increase tax structures on manufacturers, especially steel and these types of things. Depreciation schedules all play in this, both for the customers, et cetera, that have made U.S. a not favored location. We have the highest corporate tax rate in the OECD, and that clearly discriminates, and our corporate tax is global. And so therefore, no matter where the U.S. company is located, it has to pay that tax rate, even if they're competing against other companies with much lower tax rates in those foreign locations. And that, to me, explains a large reason of why we did so well during the 80s and are doing
How about
much
the
less well
currency
now.
manipulation either? You believe this
Yeah,
plays
sure I
a
do.
part in
I
this,
did.
right?
I testified before TPPF, and I think currency manipulation is a serious issue with TPPF. I think all of these things combined make a lot of difference, but the tax rates really has a hammering effect on U.S. companies in aggregate, and especially on manufacturing companies, and if I may double down, especially on steel companies. From my hometown of Youngstown, Ohio, steel was pretty important.
Right. Thank you very much.
Thank you.
Senator Cotton.
Thank you. Dr. Laffer, Mr. Hodge, one of the two of you said that obviously taxes are necessary and always have been to fund the legitimate and needful functions of government. Some are better and some are worse. Would you care to characterize which ones are the worst in terms of their impact on economic growth? What alternatives might be, and
Sure.
whether they're politically feasible?
Yeah, in fact, the OECD, economists at the OECD have looked at this in a very interesting study a few years ago. They found that corporate income taxes and taxes on capital are the most harmful taxes for economic growth, followed by taxes on income, followed by taxes on consumption, and finally taxes on property. And why is that? It all has to do with the mobility of the factor in the economy. Capital is the most mobile factor in the economy, thus the most sensitive to high tax rates. And then you see that with our corporate tax system. Income taxes are slightly less sensitive because people are less mobile. I can't follow my employer to Ireland to take advantage of that 12.5% corporate tax rate. And obviously property tax, you can't move property, so it's less sensitive to tax policy. So keeping that in mind should guide our tax reform measures as we go about trying to reform the tax system. And that's why things like full expensing are such a powerful engine for growth, is because it's reducing the cost of capital.
Dr. Laffer?
I totally agree. Corporate and personal income taxes are key. I would rank the order the other way around. The literature has a great deal to say on this, and progressive income taxes are killers. The more successful you are, the higher the rate you pay, which really teaches you how to change where you live, where you report, how you report. If you're facing a 50% marginal income tax rate, you're going to spend 50% of your time trying to reduce your tax bill rather than trying to earn more income. It's just simple math. And the literature is unambiguous that the income taxes, corporate and personal, are the key drivers, and progressive taxes are much worse than flat taxes.
Which it sounds like you were saying to Senator Klobuchar is revealed in some of your research about people moving from higher tax
Yeah.
states to lower tax states?
Well, I've just finished my book, which is The Wealth of States, which about 430 pages of combining all the literature on and all the data on states. As you all know, I do rich states, poor states every single year, have done it forever. We look at all of these and we rank them, and it's unambiguous how important taxes are for a movement of people, movement of jobs, and prosperity. If you don't believe me, look at West Virginia, unfortunately.
Dr. Bernstein, so the hierarchy we just heard from Mr. Hodge and Dr. Laffer, capital, income, consumption, property, would you care to reflect on that?
Yeah, I'm much less moved by all of the discussion on how responsive capital income is to these changes. I think the evidentiary record is quite different than has been represented. So if you look at the relationship between real investment and changes in capital tax rates, there's just nothing there. So I think that they're very much exaggerating that. If I may say, where I think I would answer your question, where I'd make a change is on the estate inheritance side of the code. And actually, Art might agree with me with this. The extent to which we favor inherited income, step-up basis, I'm sure you're familiar with, step-up basis is a huge waste of money, and it's also an economic distortion because it creates a lock-in effect. So that's where I'd start.
Mr. Hodge, you look like you wanted to respond.
Well, I kind of find it interesting that when people say that they're unmoved by the taxes on capital and what effect that'll have, then people complain about profit shifting of U.S. companies out of the United States to lower tax jurisdictions. The reason we have profit shifting, and we've seen economists such as Kim Klausing demonstrate that about a third of our corporate tax base is being moved out of the U.S. because of our high corporate tax rate. So the key to moving that tax base back into the U.S. is to cut our corporate tax rate.
Dr. Bernstein?
The extent of tax evasion and tax avoidance is remarkably insensitive to changes in the tax rate. Now, it may be the case, where Scott and I might agree, is it may be the case is if you took our corporate tax rate down to 10 or 12%, you'd see the kind of differences he's talking about. But the damage that would do to our fiscal accounts and the knock-on damage it would do to the rest of the economy would make that prohibitive. So again, I really think you have to be driven by the empirical record here, and you simply don't see the kind of elasticities, the responses that not only are these guys talking about, but they're erroneously building into their models.
Do you have anything to say about the distribution of Dr. Laffer and Mr. Hodges' hierarchy of
I
capital,
think that I
consumption?
agree with them, and I think there's wide bipartisan agreement, and again, this agrees a little bit with what Scott just said, that the corporate side of the code is a mess, and that our statutory rate is uncompetitively high. I think the difference between us is that I recognize that very few corporations in the multinational space pay anything like that.
Yeah, but
Dr. Laffer?
yeah, but it's not just what they pay, it's what the expenses are that they go through to avoid paying. And what I've done here on this is that shown that there are huge expenses that companies pay, but that don't get collected by the government in tax revenues. What we want to do, and what my paper that I read in the record does, is try to eliminate or reduce the difference between the cost to the company and what the actual government collects. And what happens is people will spend fortunes getting around the taxes so that the government doesn't get the revenue and the damage is done to the companies as well. And that just makes no sense whatsoever. If you're going to pay taxes, at least let the government collect it. But that's not what these tax codes. And if I can say, Jared, I mean, very seriously, the complexity of these tax codes and all of this stuff you're talking about is just disastrous. And you use Kansas as the example, which is really unfair because I've done the response to the IBD response. You know those numbers. Look at North Carolina. Look at Indiana. Look at these states that have done major tax reform. Look at Texas versus California. Look at Florida versus New York. Look at Tennessee versus Kentucky. Look at any of these states. For goodness sakes, the evidence couldn't be more obvious.
Now,
And it takes, I mean, sophistry of the worst example to be able to try to convolute these results into something that goes in the opposite direction.
Well, let me
It
disagree.
makes no, now, let me finish
Sorry.
first.
Sorry.
I mean, you cannot tax an economy into prosperity. You just plain can't. Everyone knows that from first grade on. And the Tax Foundation has done wonderful work on this. I would just disagree with them that they're not quite as strong a results as I think they really are. But hey, I love you. But it's just silly to argue that taxes don't matter. They matter and matter a lot, and everyone knows that. Everyone who's been in business knows that.
Thank you for, if I may quickly.
Well,
Anytime.
we have the luxury of more time here.
Well, I'm having fun, and I have the floor until someone else comes in.
Senator Cotton and I are
Yeah.
having
So
a great time. and
Dr. Bernstein,
He's still on the floor, and he's going to give you some time.
Well, I
to vote.
appreciate the opportunity because I think there actually is some common views here that I'd like to amplify, and I suspect you share them, Senator, which is that the problems with the corporate side of the code that were just described by Art strike me as spot on. And the expenses that businesses have to go to bend themselves into a pretzel, I mean, last I looked, GE, which I don't think makes tax law, has something like 1,000 tax lawyers on staff. And just like Mr. Grossbauer was saying, you know, that's inefficient. That said, it's not that the politicians and the people on this panel disagree with broadening the base and lowering the corporate rate. It's all of the industries and their lobbyists who would get dinged because, let's face it, if you're going to do revenue neutral corporate tax reform, and that's the lowest bar, I think we need more revenue, you're going to have winners and losers, and the losers don't like it. We can sit around all day and agree. Secondly, look, Art and I have a fundamental factual disagreement on the state-based evidence. We're not going to hash it out here, but I'd be happy to submit evidence to the committee in very much support of states that have, in fact, raised their taxes, are doing a lot better than states that have lowered them, and vice versa. It goes both ways.
Well, the committee, I can tell you, would welcome both of you submitting that. That's what we're here. We're not the Joint Tax Committee, but we're the Joint Economic Committee, but we do have a tax component. So we would appreciate all the information either one of you can give us. Senator Cotton, you take whatever time
I'll
you
keep
need.
rolling if no one else comes in. Dr. Bernstein, what about the fairness of that hierarchy? So here at capital and income, rich people tend to have more of that than poor people. Consumption is a higher percentage of poor people's income than it is for rich people. And property has a smaller variance, either a small single-family home to a billionaire's home who can only have a certain number of square feet and bathrooms and car garages and all the rest. But income can be infinite. Do you have concerns that the hierarchy that Dr. Laffer and Mr. Hodge have laid out is not fair?
Well, I think that it's a good question because I think they were largely answering questions vis-a-vis growth in their hierarchy. And I think that when we talk about fairness or distribution, I do think you probably have to flip that hierarchy considerably. The fact that capital income is largely concentrated among the wealthy, the ownership therein, and that it's taxed at a privileged rate builds in a level of unfairness or regressivity into a tax code. Now, broadly, our tax code is progressive, but that's on the income side. If you actually look at the benefits of favorable treatment of capital-based income, they flow exclusively to the top 20%, and within the top 20% to the top 10, 5, 1%. So that is a regressive problem.
And Dr. Laffer or Mr. Hodge, would you care to respond?
Do you want to go first? Go ahead.
Yeah, well, one of the challenges of tax reform is that what's politically popular, and that is tax cuts for individuals, is not really the biggest driver of economic growth. And what's not politically popular, and that is cutting capital taxes, is the biggest driver. So you have this sort of, I think, conflict there between politics and good economics. And somehow trying to balance that is one of the challenges of fundamental tax reform.
Yeah, let me, if I can, just say on the income distribution and what's going on, high tax rates are not paid by the top 1% of income earners. End of discussion. If you look at the effective tax rate in the top 1%, it's flat all the way across with statutory rates going up and down and all over the place. They find exemptions, loopholes. That's why I use the Warren Buffett example. It's a perfect example of how you get around your taxes and how he personally has gotten around his taxes, all legal. When you look at the migration of income from high-income tax states to low-income tax states, the wealthy move from California to Texas. They do. All of that, you can see how money walks, or in my book, The Wealth of States, we've documented IRS data from the beginning of time. If you look at estate taxes, those estate taxes filed in states that don't have an estate tax and those that do have an estate tax, they're 3 times as much in a state that does not have an estate tax than they are in states that have estate taxes, and the size of them are twice as large. People really like their own money, and I will go to great lengths to get around it. It's pure and simple common sense. And that's what they do. And Jared, all your talk notwithstanding, if you look at North Carolina, we cut the highest tax rate by 2.5 percentage points. We cut the welfare generosity variables. We cut the eligibility. And now look at North Carolina. Huge surpluses going there and prosperous, and all the boycotts have been gone there a long time. And that's McCrory, as you know. If you look at the other states, Indiana, your state, look at what's happened with Mike Pence and before Mike, whatchamacallit,
Mitch Daniels.
Mitch Daniels. I mean, it's great. Look what happened with right to work when the states there. If you look at these states, that's the way it's going. Look at right to work states growth versus non-right to work states growth. You can see it clearly. You can see it with income taxes. Jared, I just don't know where you're getting your evidence, because the academic literature is replete with the examples I'm describing. I could send you hundreds and hundreds of articles that show this. Now, they show it in different ways, different magnitudes, but no one thinks that raising tax rates increases growth.
I feel like the moderator at a debate, presidential
Jared's a good
debate
friend,
here.
but he's wrong on
You
that.
have raised Dr. Bernstein's name again, and he has 30 seconds to respond.
Well, thank you. I thank
Could
you.
somebody,
Look,
could
art
somebody pick
doesn't-
on me, please?
I'm sorry?
Could somebody pick on me, please?
I think I can arrange that, Scott. Art doesn't want to talk about Kansas. Art was instrumental in nudging Kansas to embrace the kind of supply-side tax cuts he's been arguing are absolutely, unequivocally associated with higher growth. He predicted, quote, an immediate and lasting boost to the Kansas economy. Not only has the budget there been seriously underfunded, the state's education system is in trouble there. It's widely recognized that the tax cuts were the reason for that. And as I've mentioned, job and GDP growth have really done poorly relative to neighboring places, including places that actually either increased or certainly did not lower their tax cut. The Kansas Legislative Research Department's projection suggests that the economy is going to remain weaker relative to the overall U.S. economy for the foreseeable future. This is an experiment. In fact, Governor Brownback called it an experiment, and it's a failed experiment, and you can bang the table with your shoe all day, but the data tell you what they tell you.
Dr. Bernstein, rather than talk about Kansas, let's talk about Arkansas for a minute, since we pronounced the last 6 words of that name correctly. You brought up the stepped-up basis for the estate tax. Dr. Laffer just brought it up as a critic. I want to talk about the impact it has, particularly in rural areas. I think a lot of people, when they think about the estate tax, have the image of wealthy investors who have highly liquid assets like marketable securities that when they pass away could be easily sold to pay off a tax. It's not always the case in rural areas. The classic example in Arkansas would be timber or forestry products. You own a lot of land, you have a lot of trees, it takes 40 years to make a tree, very asset high, very cash poor. Regardless of the thresholds or the exemptions, you still often see families having to break up family businesses to pay the tax. What's the right solution to that? If it's not simply repealing the estate tax, which, as you might guess, would be my proposal.
Well, the exemption for the estate tax for couples is $11 million. And the estate tax hits 0.2% of estates, not 2%, 0.2, so 2 out of 1,000. And for those who get hit by it, the average tax rate is 17%. So I would consider that to be, if anything, an extremely fair and even a regressive treatment. So I would probably push the other way, as suggested in the president's budget, to lower that threshold. He suggests a threshold of $7 million for couples. Instead of hitting 0.2% of estates, that would hit 0.3. And I think that would be a smart thing to do in the sense of revenue, meeting some of our revenue needs.
Dr. Laffer? Yeah, I think he missed your question. I think you were talking about estate taxes and what happens with them.
I was talking primarily about federal.
Oh, you were a federal.
But
well,
it's
I think,
the same economic
yeah, well,
impact, right?
the movement amongst state taxes by states is just unambiguous. Rich people move to lower estate tax states, and they take their money and their jobs with them, and they move a long time ahead of time because they aren't quite sure when they're going to die, and they do it in massive. The best one of all was a very famous senator, a guy named Howard Metzenbaum from my home state of Ohio. And Howard Metzenbaum, 6 weeks before he died, moved to Florida, where there was no estate tax. And he wasn't wrong to move to Florida. He just was wrong in espousing an estate tax for everyone else except himself. And we see it all the time. And rich people move from California, and if they don't move, they shelter their income. That's what they do. And it's all these data are just clear as bells. And, you know, when you look at the U.S., if you take tax revenues from the top 1% of income earners, we have the data back to 1913. We've got it all by account. If you look at it, when we've cut statutory rates, revenues from the top 1% of income earners rises as a share of GDP, which also rises very rapidly. When we've raised rates, tax revenues from the top 1% have declined as a share of GDP. In 1980, tax revenues from the top 1% of income earners was 1.5% of GDP. In 2006, it was 3.2% of GDP with all those tax rate reductions. If you look at that period, it's unambiguous. Rich people respond to tax rates, and they pay you more money at lower rates within reason. And that's why we want a low-rate, broad-based flat tax, so we collect those monies from the rich people and not just have them go into shelters and not pay any taxes like Warren Buffett.
Senator Cotton,
I'm exhausted.
Oh, yeah, good.
Tap down of questions.
Yeah,
Thank you all very much for the
you set the
fascinating
record
discussion.
for time allotted to members of this committee. Just 2 points in closing. I mean, this has been fascinating. I mean, we could go on for hours here.
Jared would run out, but no, just teasing.
No, we don't want to be too hard on him. But our Finance Committee, on which I sit, we brought back Bob Packwood and Bill Bradley to tell us, how did you guys get it done in 1986? Well, it was an exhausting series of opportunities and doors open and doors closed and workarounds and so forth. There's strong bipartisan support.
Great.
For in need for a comprehensive tax reform, but we just cannot seem to get the thing moving for whatever number of reasons. But I think all of you have laid out some real reasons why we need to keep pushing on this and why it's important for the country. By the way, Dr. Bernstein, I was handed a note here from my tax staff which said during the last 2 years, Kansas has exploded in growth. Labor force participation is nearly 5.3 points higher than national average. So maybe it just took longer to kick in.
The slide in my testimony on the job growth, we made that yesterday with the most up-to-date data there is.
All right, well,
I challenge your staff.
I'm not trying to promote Art's book on the states.
You made that yesterday, right?
Some of my information comes from some people we know in Kansas that basically have said, look, as long as the Royals are competing for the World Series and the Jayhawks are competing for the Final Four, life is still good in Kansas. So I don't want to denigrate Kansas too much. But nevertheless, this has been a fascinating time here with the committee. I love the back and forth. It's so much more dynamic. Throw a dynamic scoring issue into the so much more dynamic than it is just simply the question, and it's time to move on, et cetera, et cetera, et cetera. Mr. Grossbauer, I'm sorry. Mr. Grossbauer, you were part of a very, very interesting hearing here.
It was
And
quite fascinating.
I hope you enjoyed it.
I did.
If I can say, if you had simply rolled your eyes and sighed more at your panelists' responses, you would have gotten called on more in that last long round.
That's true. Listen, this is terrific. I want to thank all four of you for being here. You added a real dynamic to a very, very important debate for the future of this country. And frankly, it's been 30 years, and we're falling further and further behind. I think if there is a consensus here on anything, it is we need comprehensive tax reform, and we need it now, and our country will benefit from it. Thank you all very, very much. This hearing is adjourned.